Hello, welcome to Any Answer Answered for February 2020. Tim and I have, as ever, got a couple of questions to have a look at. I say that, in fact, we're going to look at 5 questions on this particular version of the programme. We start with a rather wonderful question, simply called Four-Legged Assistant. Sole trader client has bought a dog, and this guy is a psychologist. Rather helpfully, the writer has posted the client, not the dog. They have advised it to help, the dog is to help with their client treatments. They have capitalised the cost of the dog in their fixed assets and put all dog costs through the books. The client operate out of a city centre office, but the dog goes home with the client each night. In essence, says the author, it looks like a pet, but I just want to check I'm not missing something and barking up the wrong tree. Ha ha ha.
Well, somebody is, because if we look at the original posting, what the poster says is they have capitalised the cost of the dog in their fixed assets and put all dog costs through the books. Well, if we're looking at the cost of the animal itself, if it's capital expenditure, are they able to get
It's not revenue
tax relief?
expenditure.
Exactly, it's not revenue expenditure. So I don't know how much a dog costs, but maybe it costs a few £100. No, you can't. What you'd have to do is depreciate it. So how old is the dog? What's its expected life? Write it off over 10 years or whatever. Looking at the answers that have been posted to this query, it's not until we get almost to the end of the 50 or so answers posted thus far that anybody even mentions the fact that we're talking about a capital cost here. Of course, if they have capitalised it, no, they cannot get relief on the cost of the dog itself. But of course, the running costs or walking costs, feeding it, vet's bills, etc., they, as revenue expenses, if they're putting those through the books, then the query becomes more interesting. And fairly early on in the thread, somebody says, well, is it necessary? It's irrelevant. Doesn't matter whether it's necessary or not.
It's not an employment
We're not
scenario.
an employee. If it's a sole trader claiming it, then the question is it incurred wholly and exclusively for the purposes of the trade? And if there is some incidental but insignificant private benefit, we can ignore that. And it does very much sound as though it is incurred wholly and exclusively for the purposes of the practice of psychology. And so I would allow it. Further on in the postings, one or two of the posters do point out that there are very many instances of working dogs in various different trades and businesses which qualify for tax relief.
Our second query this month relates to pensions, and it's actually 4 different questions that we've picked out. And these come from 2 anonymous, one Carl London and one Charge MDK. And they all relate to the annual allowance, Tim. So let's talk around that general point about the abatement of the annual allowance first, please.
It's a nightmare. The reason why accountingWEB has had these 4 queries in January is because agents are beginning to realise that there's been significant underreporting or misreporting of the annual allowance excess charge. And in fact, in November last year, HMRC in their pensions newsletter reminded pension providers that if their members go over the annual allowance, typically 40,000, there will be an annual allowance excess charge, and HMRC asked the pensions companies to write to scheme members to remind them of this. The problem has been brought to a head by a combination of factors, and there's been a lot of publicity involving NHS employees because of the generous NHS scheme, but it's not just the NHS, it's head teachers, police officers, civil servants, and those lucky enough to be in defined benefit schemes in the private sector, but also individuals who are not in defined benefit schemes at all, but who pay significant amounts or get their companies to pay significant amounts of pension contribution. And I think that this is a bit of a ticking time bomb. And although we're now beyond the 31st of January deadline for filing the 2019 tax returns, I think quite a lot of agents might want to consider reviewing the pension contribution history of their clients with a view to filing amendments. And it does put agents in a very difficult position, because if on review they discover that there should have been an annual allowance excess charge reported, they're going to have to say to the client, look, we're sorry, but we've now looked at this pensions information and you do have tax to pay on it. We've got to file an amendment and do this. And how's the client going to react? A, they're going to be very unhappy at having to pay extra tax, and B, they're going to be very unhappy that the accountant didn't pick it up in the first place. But the publication of these 4 queries on accountingWEB does highlight to me what you and I have known for some time, which is that this is a risk area which HMRC are themselves becoming increasingly aware of, and which agents are only recently, I think, beginning to get their heads around. But to address the particular issues, the first question is about the tapered allowance. I can't get my head around this. Can someone help? 115,000 of gross employment income, 10,000 of employee pension payments, and looking at 3 possible methods of contribution. But we've got relief at source, we've got a net pay arrangement, we've got salary sacrifice. Well, in the context of this sort of recorded interview, I'm not going to go into the details. You know that we've done a tax calculator, the absolute Pencon tool that does this, and the salary sacrifice post July 15 has to be added in. Is it for threshold or adjusted income? One is at a level of 110,000, the other at a level of 150,000. And yeah, there is an easy answer to it. But the first thing is to get the information and then to process it correctly.
And as you say, I mean, there's confusion even in that people aren't sure if is it 150,000 where I start this question? Is it 110,000 that I start this question?
Well, in simple terms, the 110 is your earnings income and the 150 is your total income. So a hospital consultant on a pay scale of, say, 130,000 gross is over the 110, but not over the 150. But if you then add in other income, they could go over the 150, and that then creates the taper. So that will then restrict their allowance, which leads us to the second question you've identified. I note that there was only one reply to it, and that was, I've recently acquired a doctor consultant employed full-time by the NHS as a client. They've only got employment income, a little bit of locum self-employed income. My question is, do I need to declare the pensions on self-assessment? Now, the tax return has very limited boxes on which you give any information about pensions. You and I will put details of our net contributions into a personal pension scheme, but that's it. If, however, you're a member of a defined benefit scheme and you personally make an employee contribution, this NHS consultant might be paying 14.5%, say, of their gross earnings. The 130 is their gross earnings. It's very confusing to call it a net pay scheme, but that's a different story. And then the NHS itself will have a pension input amount calculated using the formula. Now, those figures don't go anywhere on the tax return. What does go on the tax return, I think from memory it's page 4, box 10 of the additional information pages, is the annual allowance excess charge. But you can only work that out if you know what the other information is. And that's where they need from the NHS the statement which the NHS pension trustees should send by October following the end of the tax year, showing what the pension input amounts are, and then it's up to the agent to work out whether they trigger an annual allowance charge. If they don't, you don't put anything on the tax return. And it's because of this, I think, that the revenue realised that there could be significant underreporting. And it's the combination of the introduction of the tapered annual allowance, which was, 3 or 4 years ago, and the way in which unused allowance can only be carried forward 3 years, that has brought all of this to a perfect storm within the last 12, 18 months or so.
And that then brings us on to the question asking if you have calculated that your annual allowance would only have been 10,000 for a particular year, but you don't then use it for perhaps 3 years from then, is it 10,000 that you've carried forwards, or is it the 40?
Yes, the carry forward question is quite an interesting one. The basic rule is that you are entitled to an annual allowance in respect of any tax year for which you are a member of a registered pension scheme, whether there are contributions, pension input amounts or not. Now, in the case envisaged in this query, the individual has income over the adjusted income level of 150,000, let's say it's over 210,000, so that the 40,000 is tapered away down to 10,000. They don't make any contributions, there are no pension input amounts. The answer is very simple. They are already a member of a pension scheme, and so they can carry forward unused allowance, and the unused will be the tapered amount of 10, not the untapered amount of 40.
Got it. Yeah, so a hugely complicated area and something that requires an awful lot of attention, an awful lot of care. Exactly the sort of thing, Tim, where you would write a spreadsheet planner and sell it. Absolute pencon, do look at it. And you will find that will answer an awful lot of questions that you face in this particular area. Full information via the Absolute website. We will be back on this website in a month's time, but until then, bye-bye.